Folks, let me be very crystal clear. This is one of the worst days I've ever seen in regards to big companies absolutely seeing their stock prices collapse on earnings. Starbucks stock is down over 17 percentage points here today. SMCI, which has been one of the hottest stocks in the market, is down 15 percentage points here today. Skyworks Solutions down about 15 percentage points here today. Estee Lauder reported earnings this morning. Massive cosmetics company, the big dog of big dogs. That one's down about 15 percentage points. AMD reported last night that stock's down over 9 percentage points. And then you got Amazon, which destroyed their earnings, and that one's barely eking out a 1% gain here today. That is how ugly it is. Absolutely astonishing, just to be quite frank. Okay. Alrighty, so there's three clips I want to react to in this one here today. The first one up here is Starbucks CEO got interviewed by Cramer, and things got very tense in this interview. Very, very tense. So we're going to get into that one, okay? Then I want to get into this one in regards to Tesla. Recent Tesla announcements and leaks have created opportunities for peers. Former Ford CEO, I want to see where they're going with that one. This one just came out 4 minutes ago, so I'm like, I need to react to that one. And then we'll finish it off with Starbucks at the very end of this one. Alrighty, folks, appreciate you joining me. Smash a like, and yeah, let's get ready to roll, man. We got drama. We got drama. Oh yeah, do we have drama in this market? Pin comment down there today. I'll put my Instagram and my X if you want to follow me on either of those platforms. If you use Instagram or use X, that'll be pin comment.
Quarter was extremely weak.
Jim, it was a very tough quarter. Thank you for having me. There were three reasons for this. First, we saw unexpected pressures on our occasional customers, more intense than we expected, that impacted their visitation. Second, the choppiness of the recovery in China continued with a more intense price war than what we expected. And third, challenges of our business in the Middle East that impacted us not just in the Middle East, but also in other geographies.
Okay.
Clearly,
I understand. Now, what I'm trying to figure out, sir, is why did you not feel the need to pre-announce this shortfall, given the fact in the previous quarter, your CFO said that she felt that you could have a earnings per share growth in the range of 15 to 20%. This is a substantial decline from that. And given the fact that you said on the call that April did not end well, I'd like to know why you did not feel the need to come out and say our quarter is going to be substantially worse than expected at least 4 weeks ago.
So this is a good question by Cramer here, and for those of you guys that maybe haven't been in the market very long, this is a very important subject, okay? A pre-announcement of a quarter is when things are so bad that you got to let investors know, okay? And it's kind of a responsibility to you as a CEO of a company to come in and say, we're going to pre-announce this number. Because if things are so bad or so great, you can always pre-announce. And I watched a lot of pre-announcements happen when I was actually first getting in the stock market. This was around like 2008, 2009, the Great Recession was going on, and companies were pre-announcing left and right because their businesses were in such a bad place. So, right now, this might have actually been a good time for Starbucks to come out and pre-announce how bad things really were.
I think, Jim, we've been working on action plans to address these headwinds. And so what we wanted to come back with was not just the announcement, but also the action plans that we have in place, which, by the way, are not business as usual. And I'm happy to talk about them.
Well, let's finish, because I know that investors are trying to figure out why they should hold on to the stock. Some of the things that I am confused about, I checked with all the major, both public and private companies that are in a similar business to you, and no one saw a 3% decline in comp stores because of weather, and none of them saw a negative number except for you. Is it possible that your coffee is just too darn expensive?
Jim, I think that if I look at the U.S. occasional customer, they have clearly cut back on visits to us. If you look at the value for money scores we have, they're still strong. But there's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide. So what we are doing about it is it's not business as usual, but there's an action plan we have in place in order to do that, to reach them and to communicate the value that we are providing. What we're doing for that is we are making it attractive for them to come back into the Starbucks app and join it. On the app, what you will see is value that they haven't seen because they've not been part of that environment. There are drops that are going to happen every Monday. There are bundles that we're putting in place that are attractive for them. For example, a beverage and a drink at a certain price. And so what you're seeing there is the effort we're making in order to ensure that our occasional customers get to see the value that we provide.
Why did the loyalty program go from 34.3 to 32.8 in linked quarter? I mean, those people are not occasional. Those people are hardcore. Why did your membership, and I know your membership was up 6% year over year. I'm not concerned with that. I'm concerned with linked quarter. Why you had not the occasional, but the hardcore drop off.
Jim, if you look at the most loyal customers, they actually continue to come in, they continue to buy us frequently, they continue to customize and upgrade. It's at the tail of the loyalty program, particularly those that are, in the 90-day active, as we call it, the folks that didn't come back. They, again, are very similar to the occasional customers. We have an action plan in place right now to communicate directly with them with offers that have gone out even as recent as this week in order to ensure that we can reverse the visitation losses that we have seen with them and to bring them back. And yes, you're right. Overall program did grow by 6%.
Jim's asking pretty good, hard questions here. And I think the Starbucks CEO is answering some of those questions pretty decently here. Now, I want to look at Starbucks and see how far down is this stock, really? What pricing are we talking? So if we go back to the peak in 2015, the stock was about $62 a share. If we go back to, oh my gosh, the peak in 2019, it was 96. It's 73 today. The Rona lows was in the mid-60s, it looks like. Somewhere around there, roughly. It might have went a little lower because it updates monthly on this particular chart. So it might have got a little more ugly than that. Maybe it went down to low 60s in the Rona crash. And then in the 2022 crash, it looks like it went down to the mid-70s, low 70s, right? And here we are, we're below kind of where it was in 2022. And I mean, if this baby keeps plummeting like this, we're going to be down to Rona lows, which is crazy because that was a time period when people thought the world was going to be shut down. And what does that mean for Starbucks and those sorts of things, right? So that just goes to show you how dramatic the fall was. Now, in the Great Financial Crisis, it's interesting. The stock actually started getting hit in 2006 is when it peaked. And then the stock fell, peak to trough. It looks like it was 19 there. And it fell, oh my gosh, all the way down to $4. All the way down to 4? Dang. I didn't know it fell that much. From 18 to 4? So, oh my gosh. Oh my gosh. I did not know Buc-ee's fell that much. So this is one of those things you look at and you're like, is this a sign of recession, right? If it is, then Buc-ee's might have a lot further to fall here. I don't know if it's going to fall as dramatically as it did there, but man, whoa.
That's necessary, but what's more important, I think, is the linked quarter decline. Now, let me, before I turn it over to my colleagues, you said it's not business as usual, and I want to make a point here, sir. You are still...
The thing with Buc-ee's is Buc-ee's was already a big giant, back then. Obviously, they're a much bigger company nowadays in 2024 than they were back in 2006, 2007, 2008. But they were still huge back then, and so that's crazy fall. It's like, what is that, like a 70% fall?
Expanding as if it is business as usual. You add, for instance, quarter decline. Now, let me, before I turn it over to my colleagues, you said it's not business as usual, and I want to make a point here, sir. You are still expanding as if it is business as usual. You add, for instance, on the quarter, you talk about opening stores in Honduras and Ecuador. Is it not time to pause, sir, and figure out what's really going wrong and spend a deep dive and making it so that this decline in comp store numbers does not continue? Because it is perilous to the actual existential existence of Starbucks.
Jim, thank you for the question. What I would tell you is, if you look across the world, our system sales in Latin America expanded double digits. Our sales in Japan expanded double digits. Our business outside of Malaysia and Indonesia in Asia Pacific showed growth. If you look at the U.S. business and look at the fundamentals of the U.S. business, we are holding share in the U.S. We are still the largest player in out-of-home coffee. If you look at some of the metrics that we have...
Tim Horton said you are not holding share, sir. I regard them as being seminal companies that are just as good when it comes to... McDonald's says you are losing share. I can't go against those three companies. They are too good and too honest and too big for me to dismiss.
We are the leading category player in coffee. I'm talking visitation share and what we have. If you look at our in-home coffee business, it grew share 140 basis points. But if you look at the business underpinning us, tea grew 8%, cold grew 1%. So
that's a rough graphic. That's a rough graphic they put up there. They put my man up there, and then they put his performance since he became CEO. Oh man, that's rough.
Elements in here. If you look at our partner sentiment and what we have inside stores, attrition is down to its lowest levels. So there's work going in. The thing we didn't do enough of is really attack the occasional customer with delivering and communicating value to them in a more aggressive manner. That's what the plan we have does.
Luxman, it's David. China continues to be a not unimportant part of the growth plan for this company. You cite fierce competition there, a slower than expected recovery. But to Jim's question again, why not sort of focus on improving things there and or fighting off the competition? You still are opening many stores. I know the net number was still a pretty significant one for the quarter in China.
David, first of all, I think if you look at the overall network of stores that we have, they're in very good health. If you look at the cash-on-cash returns that we get from the new stores and the expansion, they're 40% cash-on-cash returns. We see no reason to change that equation. It does not mean that we're not focused on fixing the challenges we have with the occasional customer and with the fact that they're not visiting us as often.
Luxman, I was noted your language in terms of citing a deteriorating economic outlook weighing on customer traffic. Do you really think that's the case? We talk about it endlessly here, as you well know, and it's far from clear that there really is a deteriorating economic outlook. So what is it you're seeing that perhaps many others are not?
I think what we are seeing is pressure.
Hold on just a minute. Let me stick up for Mr. Starbucks here. He might be right. He might be right. Here's the bottom line. You see UPS numbers? Dumpster fire. Dumpster fire for UPS. UPS. You see Southwest Airlines numbers? No bueno. You see Skyworks Solutions numbers? Wait till you hear Apple's guidance. No bueno. You see Estee Lauder's numbers? You see AMD's gaming business and their embedded business? The business has fallen off a cliff. They're down nearly 50% year over year. So to stick up for Mr. Starbucks here, inflation in the Fed might have done the job. And, it could be a lot of weakness being seen now.
The wallet for some of our most occasional customers. And they are translating that into what they're choosing to do.
All right, what are they doing then?
Well, so some of them are obviously visiting less, as we have seen, hence our action plan, which is about communicating value, which is about ensuring our speed of service improves, so we capture the demand that we already have, and thirdly, that we bring in products that they find exciting. What we are doing with products is, if you look at the lavender matcha, really appealed to some of these customers. We are bringing in new products as our seasonal launches go that are really appealing to these occasional customers as well. So it's about price, it's about value. We're bringing those two together to ensure that the occasional customers find it worth their while to spend their money at a Starbucks.
So, I don't really think the company has a drink problem. To me, the company has two issues, right? Obviously, the stance they took in regards to the situation there obviously hurt their business. They mentioned that in the Middle East, and it could even affect some of their customers in America, right? Some people are feel very passionate about that, and they refuse to drink Starbucks, because of the stance obviously Starbucks took. So it's that's what people want to do. It's their money. They can do whatever they want with it, right? So that's obviously negatively affecting them. The second thing, in my opinion, is food. Food is something this company has such a tremendous opportunity, and they have the space in most of their stores to do it nowadays, but they just don't seem to be taking food very serious. And the bottom line is, if they could get food up to a level, like people crave Starbucks drinks, right? Like, people crave a Frappuccino. People crave, a nice latte and those sorts of things. People don't crave Starbucks food. I'm just going to be honest with you guys. It's very average. Very average. Like, my expectations for Starbucks food is kind of similar to, like, if you get something out of the freezer and you heat it up in your microwave, that type of quality, right? They got to bring quality up there. And so they don't have to offer a million different items that are quality, but just a few. Just a few, in my opinion, to get sales up, so then at least people start taking it more serious as a food option as well. So that's kind of the two things that are going on there, right? Geopolitical situation and then food. Alrighty, next one up here. Recent Tesla announcements and leaks have created opportunities for peers.
What's next for Tesla? Let's bring in former Ford CEO and CNBC contributor Mark Fields. Mark, it's good to have you. We got a flash head right now from, I think, Bloomberg saying that Tesla retreats from next-gen gigacasting manufacturing process, according to sources. What are investors supposed to make of some of these headlines?
Well, I think if you're inside Tesla right now, there's probably a lot of confusion. If you're an investor, you're looking at the business right now and you're saying, listen, the last quarter, it burned cash. At the same time, you got lots of management turmoil. You got market share going down. You have more inventory than you ever held. And you're having all these kind of announcements that come out a bit haphazardly of what they're doing with costs, et cetera. So it's got to give them pause in terms of, their investment, what the strategy is for Tesla going forward. But also, Carl, if you're inside Tesla as an employee, you've got to be looking over your shoulder, because when you do these kind of reductions in workforce, usually what you want to do is you want to say, here's the percent we're cutting. Here's the date by which we'll be done with this, at least for now. And Tesla has not kind of articulated that. So it's a little bit of a drip by drip. And what you'll see inside Tesla's organization probably is a lot of paralysis right now.
Do you believe that less commitment to the charging network hastens a broader slowdown in EVs, like lowers the adoption curve even more?
Well, from a consumer standpoint, it's not a positive news, right? Because if you're a current Tesla customer, when Musk says, listen, we're going to increase the uptime of our locations, that translates into the customer saying, I'm going to have to wait more. I'm going to have more cars in front of me because he wants 100% uptime.
So what he just said there, that could be a very open view to somebody that's maybe like weak mentally, right? Paralysis in the organization because people are scared about losing their jobs. That's like me saying, guys, we need to dig these holes out here and we need to get it done before it's dark tonight, right? You could be like, when I say, if those holes aren't finished being dug by dark, you're not getting your money, right? And you're like, crap, man. Oh, man, I might not get it done before dark. So, you know what? I don't know. Like, let me think about this some more. And you're wasting time instead of digging the hole, right? Somebody that's an action taker is like, dude, I'm going to get this money. I'm going to dig this hole right now. I'm going to get this done, right? So, that's just, I mean, I could understand some people, feeling like that, but those are probably the people you don't want in your organization. You want people that are like, I'm going to get this job done regardless and make sure my value is felt here in the organization.
A customer considering a Tesla, you're saying, well, okay, it might be more inconvenient for me to charge this vehicle. And importantly, if you're a customer of any of the other OEMs that have signed up to use the Tesla network, it's just it's a net negative in terms of from a consumer standpoint. So it doesn't help. But overall, over time, the adoption of EVs will increase over time, but it's going to be slower than everybody expected. And that's why you're seeing all these announcements of pushbacks of product and facilities. But this latest announcement, overall, Carl, it's a net negative.
Putting all the announcement into context and talking about the sort of cultural issue that you see over there at Tesla, Mark, is it an opportunity for some of the competitors like GM and Ford that have been trying to catch up on EVs, or is it more bad news for them too?
Well, Sarah, it's a great question. Like I said, from an overall market standpoint, it just basically says, listen, from a consumer standpoint, we'll wait until you guys all figure this out before we consider an EV. But if you're a GM, a Ford, or one of the other automakers, there is opportunity right now, because at least if you piece together the announcements that Tesla has made or has leaked around their product plans, it just sounds like there's a lot of confusion there right now. And, what Carl mentioned about the gigacasting pushed back, you recall from, Tesla's investor day a year ago, they said that was...
Sounds like a lot of confusion. Where's the confusion coming from? Mr. Ford CEO, former Ford CEO, where's the confusion coming from? It's coming from Wall Street. There's no confusion inside the organization from anything I've heard that's credible.
Absolutely crucial to bring down the cost of their vehicles and also bringing out this sub $25,000 vehicle. So, if you're one of the other automakers, you're saying this is an opportunity for us to catch up as you see the turmoil in Tesla. And I think the launch of the GM Chevy Equinox, which is coming in the next number of months, that's priced right in the heart of the market. So I think that'll be a real touchstone for the industry to see if they can take the cost issue off the table for consumers.
Let's get back to Starbucks. I mean, the bottom line is, these other automakers have had a little fun for the past year, sticking their chest out and acting like they're all bad and they got everything going. And I'm just telling you, they're going to feel the pain. I'm already starting to see in some of these other automakers' numbers that they're already feeling the pain. But that's just a start. Like, it's going to get much worse for these companies. But the thing with Tesla versus the other automakers, these other automakers are going to start taking losses, big losses on their bottom line. Versus Tesla. Tesla, they still make money. They still make profits. Net income positive. There's a big difference there. These other automakers are going to start taking losses. They're not going to reinvest into the EV business. We're going to put them further behind the long-term opportunity, right? They're not going to be able to invest, even though they're not investing in self-driving vehicles and that technology, and so which puts them even further behind on that, which just is going to lose them the long-term battle of EVs and the long-term battle of self-driving vehicles. So, just wait. The real big pain is coming for the other automakers.
On the top and bottom lines, reporting a surprise decline in global same-store sales. Joining us now is Kevin McCarthy, portfolio manager at Neuberger Berman. Kevin, it's great to have you on. You don't actually hold shares of Starbucks, but I am curious to get your thoughts on this, because on a day where we heard more commentary about cracks in the consumer, specifically the low-income consumer, with McDonald's this morning, with Coca-Cola this morning, just the latest to comment on that, the higher-end consumer has held in pretty well. And Starbucks historically has been more in the Chipotle camp than the McDonald's camp. So the fact that we saw same-store sales fall in North America, but also globally, including other key markets like China, what's the read-through?
Tough.
I think, Morgan, thank you. The read-through is that we are seeing pressure across the complex geographically and by demographic income cohorts. I think McDonald's even recognized this morning or noted that they're seeing that a similar pressure across the board. The miss, though, however, for Starbucks is quite significant. I think at this point, a guidance reset is certainly in play. That we're looking for 15 to 20% growth. Coming into this print, I was thinking a 10%, lowered it to a 10% EPS would be sufficient.
The thing with Starbucks, they've gotten so big now, okay, is you even go into a lot of, what's the best way to put it, poorer communities, more, lower income communities, let's call it that, right? Might be the politically correct term, lower income communities. There's Starbucks there now. You go back 15, 20 years ago, there was not Starbucks in low-income communities. Starbucks was only in the wealthier communities. You kind of knew, like, if you saw a Starbucks, like, oh, this is kind of like middle-class, upper-middle-class community, like, those sorts of vibes. you can go into almost any lower income community in America now at this point in time, and you'll find a Starbucks somewhere in there, right? And so they've kind of become a little bit like McDonald's, where they're willing to put them almost anywhere now at this point in time because they feel like they have that strong of a brand and people will pay for it. So there's no doubt they can get hit the same way McDonald's gets hit.
To be honest now, I don't even know if a plus mid-single digit, which would put the stock at, the EPS at around 370 for fiscal 24 is sufficient, because that in itself, would assume or underwrite expectations for double-digit EPS growth in the second half, and you need to have positive comps and positive margins. So, as it relates to the consumer, I think, one of the messages that we're hearing and the takeaway from the first quarter is that we all knew that pricing was going to be rolling off coming into the year, that it was going to be a challenge to get traffic, and that the digital pinpointing and trying to target consumers on this with their digital apps was a hope. And now I think we're seeing that hope is not coming through, and that more likely than not, we're going to see more aggressive value wars over the summer across the restaurant complex.
Yeah, we've already started to see it within the consumer staples space, the pushback from consumers on all of the price hikes and price increases. I mean, when we talk about a $6 or $7 fancy coffee, are we starting to see it here now as well?
For sure. I mean, they highlighted last quarter that one of their weaker periods or one of their weaker day parts was the afternoon, which is you're less frequent. It's a more of a discretionary purchase. And so that is a challenge for them. But beyond that, I think the challenge, and I can kind of compare McDonald's and Starbucks because they both had a similar setup. They're both tracking from a traffic perspective below average, and they're below their long-term algo. But it's easier to diagnose McDonald's. McDonald's, they can put out national value, and you think that's going to be price is going to cut it. For Starbucks, the challenges are you don't really know how to model because you're not sure if is it a social issue? Is it a cannibalization issue? Is it a cold beverage mix, which they've now got a lot of, or is it competition?
Well, here's what I wonder about, Kevin. I'm looking at comparable transactions in North America and U.S. down 7%, but average ticket actually up 4%. So it makes me wonder, are they a victim of trade down where maybe a certain segment of the population, maybe higher end, is still going to them and spending, but then a whole cohort has just kind of said, oh, well, I'm going to save on coffee and not do that and maybe make it at home?
That's absolutely could be the case. And I mean, we're seeing some consumer balking in the afternoon day part, probably on what you're alluding to. But, if you look at some of the international regions, internationally, not only do they have, in the U.S., the price is positive and traffic is negative. But if you look at it internationally, they're both negative. So I think, for investors trying to pencil out how to model the second half of this year, you really don't have a lot of certainty that even if you do cut prices, which is obviously going to take a hit on the top line and on margins, that's going to drive traffic, and that's going to be a source of upside for you in that case. And we haven't even gotten to China, which is another piece in of itself. Which I think the underlying story there is just that the possibility of that being an upside driver is probably pretty limited, given what you've seen from a competitive dynamic there.
Yeah, so obviously Starbucks is a mess all over the place. Am I ready to run out and buy Starbucks right now? And the answer is no. Not right now. I mean, at the end of the day, oh man. Woo. Too many problems. Too many problems all over the place for Starbucks. So there's a lot of other opportunities in the market. There's a lot of other opportunities that just don't have all these issues all over the place as Starbucks has, right? All right, guys, appreciate you joining me as always. Pin comment down there if you want to follow me on X or you want to follow me on Instagram. That'll be the pin comment down there today. Much love and have a great day.